That's all of the themes from today. I'm joined by the founder, CEO and president of Banríon Capital Management. It's Shana Orczyk Sissel. A warm welcome to you. So let's get stuck in here and talk about the debt ceiling situation, the drama that we've all been watching this week. It seems to be coming to an end. But what damage, if any, do you think it's already had then, would you say, Shana?
Well, I don't think it's done much damage per se. I think we all kind of anticipated that they would get a deal done because politicians want to be reelected. So they'll hold their ground only long enough to make a point, but they also understand that not getting a debt ceiling deal done would have been catastrophic. So I don't think it's done much damage, but I will say that going into the debt ceiling negotiations, the Treasury had to put liquidity into the system. And one of the reasons why we have seen some resilience in markets and inflation being sticky high is because of excess liquidity in the system. After SVB, they put liquidity into the system, and then into this debt ceiling negotiation, liquidity was put into the system. I would expect that this will now be pulled out of the system, and subsequently, you will start to see pressure on the markets, and hopefully we'll see inflation start to come closer to the Fed target of about 2%. I think it's actually a real target of closer to 3%, which is more in line with historic average. But the Fed keeps saying 2%, and I think you'll start to see the inflation number come down now as liquidity gets pulled from the system.
OK, we're going to talk about inflation again in just a moment or two, but I just want to pick up on the labour market right now because it seems to be showing more and more strength. We've got the non-farm payroll numbers coming out tomorrow. What does this mean for the Fed? Because it is such a strong element of the market right now.
Well, the Fed has said that the two main indicators that they are looking at when making their policy decisions are the inflation number and the employment numbers. Employment over the last 10 months, while the Fed has been tightening, has actually gone down. The unemployment rate has gone from 3.6% to 3.4%, which is not at all what you would expect in a tightening monetary policy environment. So this is going to put the Fed in a difficult situation. They really have indicated that their intent is to pause in June. But if the job numbers are very strong and the inflation numbers remain sticky, they may be at a point where they don't have that luxury. They may pause in June, but I don't think rate hikes are over. I do think they're going to be forced to hike rates again, at least another 25 basis points. And the idea that they might cut in this calendar year, I think, is just completely not realistic. I think more likely than not, rates will go higher, not lower in 2023. OK, so more hikes to come from the sounds of it. I want to stay with inflation if we can for now, because it's incredibly sticky. And just earlier, I was looking at the movers in the market today, and it seems like we've got the likes of Macy's, Dollar General. The consumer is really struggling right now with inflation. What can be done about this? What can be done is what's being done, the Fed maintaining and tightening policy. I think that it's interesting because there's kind of a split here. The lower end average consumer is under pressure, but there's still about $1 trillion in excess savings, but mostly in the higher end, higher income consumers. So there's this split that's happening, but we are seeing increased credit card debt write-offs and defaults, even though we haven't seen unemployment rise and we haven't seen a lot of pressure on incomes per se. But I think inflation is really starting to take its toll on the average consumer and the lower end consumer. And when you think about the retail players who have struggled, it's Dollar General, it's Target, it is Macy's. These are not super high-end retailers. So it's not surprising. And I think that there's still more bad news to come as it pertains to that.
OK, and talking about bad news, small caps have had a really tough time of it.
They have. And interestingly enough, you know, a lot of people think that the market bottom occurred in October. But if that is true, off a typical market bottom, small caps will rebound substantially, usually upwards of 50 to 60% in the 6 months following. Since we saw the market bottom in October, small caps are flat. So that is actually not a good sign, and suggests that that probably wasn't actually the market bottom. So I do think that as now we get this liquidity out of the system, continued pressure on the consumer, and the Fed kind of in a rock and a hard place with sticky high inflation and a unbelievably robust job market, that is going to cause them to tighten even more. I think we could see rates go up over 6% before the end of the year, which is going to really put pressure on margins, corporate earnings, and just in growth in general. But the Fed has said that they are okay with that. They kind of want that because that's what it's going to take to get the economy back in check.
Yeah, not much choice in the situation. Shana, thank you so much indeed from Banríon Capital Management. Thank you for your time.